Hey, I'm Ben from Modern Graham, and today we are going to talk about Paramount Global and go through a stock analysis of the company using the Modern Graham approach. So be sure to stick around for that. First of all, we have Para, that the ticker is PARA, and the current price is about 1805. The sector that we're looking at is communication, and the industry is media. Of course, this is Paramount. They do lots of TV stuff, and Star Trek really is what I know them for. And I mean, that's what I am a subscriber for their service for, and why I love it. If you haven't watched Star Trek, perhaps you should. It's an awesome show. But anyway, balance sheet. These, as usual, are the things that I find most important from the balance sheet. We have current assets and current liabilities, total debt, in total assets, intangible assets, total liabilities, and the outstanding shares. All of those figures will come into play in the analysis ahead. Looking at earnings, we have had a bit of a shaky earnings situation overall. It bounces around. It had a huge drop in 2004 and 5, and again in 2008. But other than that, they've been relatively stable. Now, these big drops did play into the earnings per share Modern Graham being negative for several years. Earnings per share Modern Graham is a weighted average of the earnings per share using the last 5 years. It looks at these ones here to get that figure, putting the most weight on the most recent. So you can see that the earnings per share have been rising slowly. For the most part, we've seen a lot of growth on the earnings per share Modern Graham side, which really goes to indicate that they have improved from these really down years. Dividends, you can see that they are paying a dividend pretty steadily. Even on their worst year, 2004, they still paid dividends, and they cut back a little bit in there. And then again, the financial crisis, they dropped their dividend quite a bit there, but they still continued to pay it. Their dividend payout ratio is rather low for many companies that we've been looking at lately, and that would indicate that they have the capacity to continue growing their dividends, or at the very least, they have the capacity to sustain the dividend if they have another down year. So those are things to pay attention to. Dividend yield is currently really well, and that's why it is getting reviewed today, because this was one of the 10 companies on my high yield companies watch list video that I did last week. You might want to check that out as well. The link will be at the end of this video. But anyway, here's the graph. Blue is the earnings per share, and you can see, again, it has bounced around a little bit, but it has been more steady in the last 10, 15 years than it was before that. Dividends per share, again, have been steadily rising as well. Moving on to stage 1 in the analysis, where we look at whether the company is suitable for the defensive investor or the enterprising investor. So the defensive investor is somebody who wants to have individual companies in their portfolio, but they don't have as much time to do research. So they have a really high level of a high threshold for whether or not they will look at the company further. First, they require that the market cap be over $2 billion. It passes that test. It does not pass the current ratio test. Current ratio for Para is 1.47, but the defensive investor requires 2, and so it fails there. Earnings stability, it has had earnings positive for over 10 years, so we pass that test. Dividend payments, it requires 10 years of dividend payments. It passes that test. Earnings growth, earnings have grown by 52% over the last 10 years using 3-year averages at the beginning and end, so it passes that requirement. And the moderate price to assets, the price to book ratio is only 0.51, so it has a really good book value, so it passes that as well. In fact, according to this, the price is trading below the book value, so that would be a very interesting part of this as well. So overall, we have 6 points out of 7, so it is suitable for the defensive investor. The enterprising investor is somebody who is willing to take the time to do more in-depth research. And as it says here, if it's suitable for the defensive investor, then it is automatically suitable for the enterprising investor. That's the case here, even though it fails 2 out of the 5 tests for the enterprising investor. It fails the current ratio, just barely, and it fails the debt to net current assets requirement. So it has higher debt than you want to see here. But overall, it passes earnings stability, dividend, and growth, and it gets a score of 3. And it is suitable for the defensive investor, enterprising investor, like I said, because it is also suitable for the defensive investor. Stage 2, it's time to look at the intrinsic value. So to do that, we look at the modern Graham value formula, which is taken from Benjamin Graham's teachings in his book, The Intelligent Investor. And that is value equals earnings per share times 8.5 plus 2 times the growth rate. So we have 2 variables we need to figure out. We have earnings per share. I use my weighted average earnings per share, MG, or modern Graham. And we look at this and we take the 5 years of earnings and we calculate the weighted average here, 455. Plug it in over here. The growth, we can take that and the earnings per share from 5 years previously, and we can calculate a total growth over those 5 years of 10.65%. Divide that by 5 and we get an average growth of 2.13% each year. Then we have a safety margin of 0.75. So the growth is capped in this case at 1.6%. That is because growth is such a key figure in this calculation that you want to be extra careful with your growth estimate. So then we take the earnings per share and the growth and we get a value of 53.22. That is substantially higher than the current price. So over here, we can see that the opinion is it is undervalued based on that. Net current asset value we'll talk about in a moment, but it is negative here, so that doesn't play into the value calculation at this time. Modern Graham value based on 3% growth. If you assume that the company will grow at 3%, that is what the value would be. If you assume that the company will not grow going forward, sorry for that noise, then it will be 0% and the value is 38.68. So the market is actually implying that the weighted average of earnings will be going down. That is one thing to keep in mind. We calculate this by putting price in the value formula and solving for growth. Coming down here, Modern Graham grade. This is a score based on several different factors. First, investor suitability. It gets 2 points for being a defensive investor stock, 1 point for a good price to value, 1 point for trading below its Graham number, which we'll talk about in a moment, 0 points for having long-term dividend growth. It has not grown its dividend over the long term, and a dividend yield over 2%. It gets half a point. And the PEMG is below industry average. It gets half a point there. It is not trading below its net current asset value, so 0 points there. But overall, it gets 5 points and a grade of A. Moving on, stage 3, further research. So at this point, I can't recommend that you buy a company, but I can recommend whether or not you look into it further. You have to decide for your own portfolio whether or not this company is suitable. And these are some things that you might consider. Net current asset value, again, this one is negative, so it doesn't play in here. But it's also good to know what it is at for that. Graham number formula, a lot of people use this to figure out a value. It is based on a reading of the defensive investor requirements and calculating out companies that should fit in that if they're trading below. So earnings per share, this is the regular earnings per share, that's 249. Book value per share is 35.11. And taking the square root of 22.5 times these two numbers, you get the Graham number of 44.35. So that is one thing to keep in mind. It is trading rather below that. PEMG formula, that's price to earning, or price to earnings using the earnings per share modern Graham figure. the weighted average earnings, and that comes to 3.97. That is a very low PEMG. Other useful information, we have a current ratio of 1.47, price to book ratio of 0.51, dividend yield of 5.29% based on the current dividend, and it has only 1 year of consecutive years of dividend growth. So those are things to keep in mind. All right, now stage 4 is to look at the chart. And if you've determined that this is a good company for your portfolio, it's time to then look at the chart and decide if it's a good time to buy. This one is a little bit concerning. So over the last few months, it has had a downward trend, as you can see here. I mean, the whole market has been on a downward trend all year. But this one, you can see it has a pretty solid trend line on the upside and the downside here. And so it probably will stay in that and continue. If it breaks above that, it might be a good sign. If it breaks below that, it would probably drop even further. And unfortunately, there isn't really any level of support until around $12, between 11 and 12. So there's a lot of room that this one could drop further, and that would be a big concern. But down here we have the RSI, which is a figure that can help figure out if something is currently oversold. And right now, that figure, it is looking rather oversold, although there is room to drop a little bit further. And that could just be a matter of coming down and then coming back up. It might break through that, but I would really want to wait to see how it does moving up higher, and maybe come down and test this. Like if it comes above here and then comes back down and tests that line and then comes back up, that would be a really good sign. But for now, that is kind of what to watch, is that trend line there. But yeah, that's it. Be sure to click on the video on the screen now. That would be the list of all 10 companies that have high dividend yields that we're looking at right now. But yeah, thanks for watching, and I'll catch you next time. Take care.